Carol worked as an accountant for 31 years. She filed her taxes every April without a problem. She knew the rules, she knew the forms, she knew the deadlines. She retired in June of 2024. By February of 2025, she had received 2 IRS notices she had never seen in her entire career. One was about estimated tax penalties. One was about a withholding discrepancy on her Social Security income. Neither was catastrophic, but both cost her time, money, and the specific anxiety that only an envelope from the IRS can produce. Carol had not done anything wrong in retirement that she had not done as a worker. The problem was that the IRS had moved the goalposts. The rules that governed her tax life as an employee had changed in ways she did not realize the moment she stopped receiving a paycheck. Her income was different now. Her withholding situation was different. Her reporting obligations were different. And the 5 areas where the IRS applies the most scrutiny to retirement income are areas that most retirees have never been warned about. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making any decisions about your specific situation. My name is Olivia. Every week I break down the tax rules, the financial traps, and the strategies that protect retirees from the things nobody else is explaining. If that sounds like something you need, hit the subscribe button right now and turn on notifications so you never miss a video. Today, I'm going to walk you through the 5 specific areas where the IRS changes how it watches your money the moment you retire. These are not abstract concepts. Each one has a specific form, a specific deadline, and a specific penalty if you get it wrong. And every one of them is something that an employee never has to think about because their employer handles it for them. When you stopped working, your employer stops handling things for you, and the IRS does not send a welcome packet explaining what just changed. The first thing that changes is withholding. When you were an employee, your employer withheld federal income tax from every paycheck. You filled out Form W-4 when you started the job. You chose your withholding, and for the rest of your career, the system ran automatically. The taxes came out before the money hit your account. Most employees never owed a large bill at filing time because the withholding had already covered it throughout the year. The moment you retire, that automatic system stops. Your income in retirement comes from multiple sources that do not have automatic withholding the way a paycheck does. Social Security has voluntary withholding. IRA and 401k distributions have optional withholding at rates you choose. Pension income has a withholding form called W-4P that you can fill out, but most retirees never do. Investment income from dividends and capital gains has no withholding at all. Rental income has no withholding. Interest income has no withholding. The result is that most retirees arrive at their first retirement tax season with a significant underpayment they did not see coming. The IRS expects you to pay taxes on income as you receive it, not in one lump sum in April. If you underpay throughout the year by more than $1,000, you may owe an underpayment penalty on top of the tax itself. The underpayment penalty rate for 2026 is 7% for the first quarter and 6% for the second quarter. These rates change quarterly and compound on the amount you should have paid, but did not. Before explaining the fix, let me give you the IRS safe harbor rule because it is the specific number that determines whether you owe a penalty. The IRS will not charge an underpayment penalty if you paid at least 90% of your current year tax liability through withholding and estimated payments combined, or if you paid 100% of your prior year tax liability. If your prior year adjusted gross income was above $150,000, the safe harbor increases to 110% of your prior year liability. This means that in the first year of retirement, the easiest way to avoid an underpayment penalty is to look at your prior year tax return. Find line 24, which shows your total tax, and make sure your combined withholding and estimated payments for the current year equal at least that amount. You may still owe some tax at filing time if your income changed significantly, but you will not owe the underpayment penalty. The fix is straightforward, but almost no retiree implements it automatically. For Social Security income, file Form W-4V with the Social Security Administration to request federal withholding. The options are 7%, 10%, 12%, or 22%. For pension income, file Form W-4P with your pension administrator to set withholding. For IRA distributions, request withholding when you take each distribution. And if your income is irregular or comes from sources without withholding available, make quarterly estimated tax payments using Form 1040-ES. The estimated tax deadlines for 2026 are April 15th, June 15th, September 15th, and January 15th of 2027. Missing a quarter triggers a separate underpayment calculation for that quarter. The IRS does not average your payments across the year if you pay everything in the last quarter. There is one more withholding situation specific to pension income that catches retirees who worked in government or who have defined benefit plans from former employers. Many pension plans include a portion of after-tax employee contributions. If you contributed after-tax money to your pension during your working years, that portion of each payment is a return of your own money and is not taxable. The IRS calls this the cost recovery method or the simplified method for calculating the exclusion ratio. The IRS specifically watches whether retirees with pensions that include after-tax contributions are correctly calculating the non-taxable portion and reporting it on their return. The simplified method worksheet is an IRS publication 575. If you receive a pension that partially consists of after-tax contributions and you are reporting the entire payment as taxable income, you are overpaying. If you are reporting more as non-taxable than the calculation supports, the IRS will flag it. Many retirees and even some tax preparers are not aware of the cost recovery exclusion. If you have any pension from a job where you made after-tax contributions, this is worth verifying before you file. The second thing that changes is how the IRS monitors your Social Security income. When you retire and begin receiving Social Security, you receive Form SSA 1099 each January showing your total benefit for the prior year. This form goes to both you and the IRS. The IRS already knows exactly how much Social Security you received before you file. What the IRS is watching specifically is whether you correctly calculated the taxable portion of your benefits and whether you reported it accurately on line 6B of Form 1040. The calculation uses combined income, which is your adjusted gross income plus non-taxable interest plus 50% of your Social Security benefits. If that number exceeds $25,000 for a single filer or $32,000 for a married couple filing jointly, a portion of your Social Security becomes taxable. Above $34,000 single or $44,000 joint, up to 85% may be taxable. The mistake most retirees make is assuming Social Security is tax-free because they paid into it for decades. It is not tax-free if your income is above the threshold, and the IRS cross-references the SSA 1099 it receives from the Social Security Administration with what you report on your Form 1040. If those numbers do not match, or if the taxable portion calculation appears incorrect, the IRS flags it. There's another Social Security reporting issue that specifically affects people who retire mid-year rather than at the beginning of a year. If you retire in June and collect Social Security starting in July, you will have 6 months of earned income from your job and 6 months of Social Security. The Social Security Administration applies an earnings test if you have not yet reached your full retirement age, which is 67 for people born in 1960 or later. Under the earnings test in 2026, if you earn more than $24,080 in the year before reaching full retirement age, the SSA withholds $1 in benefits for every $2 earned above that limit. This is not an IRS rule. It is an SSA rule, but it creates a tax reporting complication because if the SSA withholds some of your benefits due to excess earnings, the amount you actually received in benefits may be less than the amount on your SSA 1099. The 1099 reports the amount you were entitled to, not the amount you received after withholding. When you report Social Security income on your return, you report the amount in Box 5 of the SSA 1099, which is the net benefit received after any SSA withholding. The IRS receives the same number, but if you're confused about which number to use and report the wrong figure, the IRS will send a notice. For retirees who retire mid-year in the year they first claim Social Security, there's also a special first-year rule that allows the SSA to use a monthly rather than annual earnings test. This can significantly increase how much you're allowed to earn in the partial year of retirement without losing benefits. If this applies to you, contact the Social Security Administration directly about the first-year rule and how it affects your benefit calculation. The other thing the IRS watches specifically is whether you are withholding appropriately on your Social Security benefit. If you have Social Security withholding set up via Form W-4V, those withholding amounts appear on the SSA 1099, and the IRS verifies them against your return. If you set up withholding but never updated it to reflect your actual income in retirement, you may be significantly underwithheld. Let me put a real dollar amount on the withholding problem so it is not abstract. Robert retired in January 2026. His retirement income for the year is $36,000 in Social Security, $24,000 from a pension, and $18,000 in IRA withdrawals. His total income is $78,000. When he was working, his employer withheld roughly $14,000 in federal income tax throughout the year. Robert set up no withholding on his Social Security. His pension withheld $2,000 at the default rate. He took his IRA withdrawals with no withholding. When Robert files in April, his federal tax liability is approximately $2,500 based on his income and filing status. He's only had $2,000 withheld all year. He owes $8,500 at filing plus an underpayment penalty because he did not make quarterly estimated payments. The penalty is not enormous, but combined with the unexpected $8,500 bill, it is a serious shock for someone on a fixed income. Robert made no errors. He broke no rules. He simply did not set up the replacement withholding system that his employer had been running automatically for 30 years. The third thing that changes is 1099-R reporting from retirement accounts. Every distribution you take from a traditional IRA, a 401k, a 403b, or a pension generates a Form 1099-R that goes to both you and the IRS. The IRS receives your 1099-R forms before you file your return. When you file, the IRS compares what those forms say to what you reported. The specific things the IRS is watching on 1099-R forms include whether you correctly identified the taxable and non-taxable portions of each distribution, whether you correctly applied the exception to the 10% early withdrawal penalty, if applicable, and whether required minimum distributions have begun and are being taken correctly. The distribution code in Box 7 of the 1099-R tells the IRS a great deal about the nature of the distribution. Code 1 means early distribution without exception and flags the 10% penalty automatically. Code 2 means early distribution with exception and requires you to explain the exception. Code 4 means death benefit. Code 7 means normal distribution after 59 and a half. If your custodian assigns the wrong code, which happens, the IRS will apply the wrong tax treatment and send you a notice. Retirees who take distributions before age 59 and a half and claim an exception to the penalty need to report the exception on Form 5329 attached to their return. Failing to file Form 5329 when you are claiming an exception is one of the most common causes of IRS notices for early retirees before getting to required minimum distributions. There is one specific 1099-R situation that creates problems in the first year of retirement for people who had 401k plans. When you separate from a job and roll over a 401k balance to an IRA, the custodian issues a Form 1099-R for the full rollover amount. Box 1 shows the gross distribution. Box 2A should show 0 as taxable amount if it was a direct rollover. But if the code in Box 7 is wrong, or if the rollover was not done as a direct trustee-to-trustee transfer, the IRS may treat the entire amount as a taxable distribution. A retiree who rolls over $300,000 from a 401k to an IRA and receives a 1099-R with the wrong code could receive a notice proposing tax on $300,000 of income. The retiree did everything right, but the form does not reflect it correctly. The fix is to review every 1099-R you receive in your first year of retirement line by line before filing. If the gross distribution amount in Box 1 does not match what you actually received or rolled over, call the custodian. If Box 2A shows a taxable amount on a rollover that should have been tax-free, call the custodian. Corrected forms take time to arrive and can delay your filing, but it is far better than filing an incorrect return and dealing with the notice afterward. Required minimum distributions create a separate tracking issue. Beginning at age 73 for retirees born between 1951 and 1959, and at age 75 for those born in 1960 or later, the IRS requires a minimum annual withdrawal from traditional retirement accounts. The custodian reports distributions on Form 1099-R but does not verify whether the amount taken met the RMD requirement for the year. That verification is the account owner's responsibility. If the IRS believes you took less than required, it can assess a 25% excise tax on the shortfall. Under the Secure 2.0 Act, that penalty drops to 10% if you correct it within 2 years using Form 5329. If this is helping you understand what you need to set up correctly before your first full retirement tax year, hit the like button right now and share this with any retiree you know who's heading into their first year without a paycheck. Subscribe and turn on the bell so you never miss a video like this one. The fourth thing that changes is capital gains reporting. When most people are working, their investment income is relatively modest compared to their salary. They hold accounts, collect some dividends, maybe sell a few positions. Capital gains are a line on their return, but not a primary concern in retirement. This changes for 2 reasons. First, many retirees begin drawing down investment portfolios to fund living expenses, generating capital gains from sales they would not have made while working. Second, retirees have more flexibility to time income, which means they should be managing capital gains strategically, but often are not. What the IRS specifically watches is the Form 1099-B and Form 1099-DIV from brokers and mutual funds. These forms are sent to both the account holder and the IRS. When you sell an investment, the 1099-B reports the proceeds. It often also reports the cost basis. If the cost basis is reported to the IRS and you report a different gain or loss, the IRS will flag it automatically. The most common problem retirees encounter is with inherited investments and old accounts. A stock held for 30 years may have a cost basis that is completely wrong in your broker's records because it was purchased before electronic tracking was standard, it was inherited, or it was transferred between brokers without the basis information carrying over. If you sell that position and report a gain based on the correct basis, but your broker reports an incorrect cost basis to the IRS will send a CP 2000 notice proposing additional tax based on the discrepancy. The second capital gains issue specific to retirement is the interaction between long-term capital gains and the RMA threshold for Medicare. In 2026, the RMA first tier begins at $19,000 for single filers and $218,000 for married couples. Long-term capital gains, even at the 0% rate, still count towards your modified adjusted gross income for purposes. A retiree who strategically harvests capital gains in a year when income is otherwise low may trigger a Medicare surcharge 2 years later that wipes out the tax savings from the 0% gains rate. The IRS is not causing this problem. The interaction between the capital gains calculation and the IMA lookback is simply a consequence of how multiple systems use the same income numbers. But the IRS will apply the RMA surcharge and the capital gains tax independently and correctly. It is the retiree who fails to model the interaction in advance who ends up paying more than necessary. Let me give you a specific example of how the 1099-B mismatch triggers a notice. Linda retired and sold a stock she had held for 22 years. She purchased it for $3,000 in 2004. It sold in 2026 for $41,000. Her actual gain is $38,000. But Linda transferred her brokerage account from one firm to another in 2015. The new firm received the shares but not the cost basis records. In their system, the cost basis shows a 0 because they have no record of the original purchase. Linda's broker sends a Form 1099-B to the IRS showing proceeds of $41,000 and cost basis of 0, implying a gain of $41,000. Linda correctly reports a gain of $38,000 on her return. The IRS receives the 1099-B showing $41,000 in gains. Linda's return shows $38,000. The IRS sends a CP 2000 notice proposing additional tax on $3,000. Linda can resolve this by providing documentation of the original purchase price, but it requires pulling records from 22 years ago, responding to the IRS within 30 days, and proving something that should never have been in dispute if the basis had transferred correctly. The lesson is simple. Before you sell any long-held investment in retirement, Verify the cost basis your broker has on file. If it is wrong, correct it before the sale. The fifth thing that changes is self-employment and side income reporting. Retirement for many people is not a complete stop. It is a transition. Consulting work, freelance projects, part-time jobs, rental income, selling items online, teaching, tutoring, these all continue or begin in retirement, and they all carry IRS obligations that are different from what a traditional employee faces. The moment your net self-employment income reaches $400 in a year, you owe self-employment tax at 15.3% on 92.35% of that income on top of ordinary income tax. You also must file Schedule SE with your Form 1040. Many retirees who pick up part-time consulting work after retiring do not realize they are now subject to self-employment tax because they have never been self-employed before. An employee has FICA taxes withheld by their employer. A retired consultant pays both the employee and the employer's share directly. The IRS cross-references Form 1099 NEC forms sent by clients who pay a single contractor more than $600 in a year. If a former employer pays you $10,000 for consulting work and files a 1099 with the IRS expects to see Schedule C and Schedule SE on your return. If you forget to include them, the IRS will send a CP 2000 notice. There is a significant tax advantage available to retirees who do self-employment work that most miss entirely. If you are self-employed in retirement and you pay for your own health insurance, including Medicare premiums, you may be able to deduct 100% of those premiums as an above-the-line deduction on Schedule 1 of Form 1040. This deduction reduces your adjusted gross income directly, which in turn reduces the amount of your Social Security that is taxable and may keep you below the A threshold for Medicare. The deduction is available for premiums paid for yourself, your spouse, and your dependent. It cannot exceed your net self-employment income for the year, and it cannot be claimed for any month you were eligible for employer-sponsored health insurance through a spouse's employer. For a retiree doing consulting work with $30,000 in self-employment income and paying $24,000 in Medicare premiums and supplemental insurance, this deduction can reduce their AGI by nearly $24,000. At the margin, that reduction can determine whether their Social Security is taxable at 85% or 0%. The difference in annual tax can be several $1,000s from a single deduction that many self-employed retirees never claim because they did not know it existed. The self-employment tax obligation does not go away because you are receiving Social Security. The IRS is explicit on this point. Earning self-employment income while receiving Social Security means you owe self-employment tax on the income. The only change is that your Social Security benefit is not reduced by self-employment income once you have reached your full retirement age. There is one more category of side income that affects retirees more than most people realize, and it became significantly more visible to the IRS starting in 2024. If you sell items online through platforms like eBay, Etsy, Facebook Marketplace, or any payment platform that processes payments to you above the IRS reporting threshold for the year, you will receive a Form 1099-K from that platform. The threshold has changed multiple times in recent years, so verify the current amount with your tax preparer or at irs.gov before the year ends. This form is also sent to the IRS. Many retirees who downsize, sell collectibles, sell crafts, or simply clean out decades of accumulated possessions assume that selling personal items is not taxable. For items you sell for less than you paid, there is generally no taxable gain. But if you sell something for more than your original cost, that is a capital gain that belongs on your return. And if you receive a 1099-K for the transactions, the IRS has the information before you file. The IRS matches 1099-K amounts to Schedule D or Schedule C, depending on the nature of the sales. If you receive a 1099-K and file nothing explaining those payments, the IRS will send a notice. Rental income is another area the IRS watches closely in retirement. Rental income is ordinary income reported on Schedule E of Form 1040. If you own rental property and have been writing off depreciation, the IRS tracks those deductions. When you eventually sell the property, the accumulated depreciation creates a separate tax liability called depreciation recapture tax at up to 25%, which exists in addition to the capital gains tax on the price appreciation. Many retirees who sell rental property in retirement are shocked by this bill because their advisor or accountant never explained that depreciation taken over 20 years would come back as a tax liability at sale. One final point on investment income that applies specifically to higher income retirees. If your modified adjusted gross income exceeds $200,000 as a single filer or $250,000 as a married couple filing jointly, your net investment income is subject to an additional 3.8% net investment income tax. This is separate from ordinary income tax and capital gains tax. It applies to interest, dividends, capital gains, rental income, and passive business income. The NIT was created in 2013, and a significant number of retirees who have accumulated substantial investment portfolios hit this threshold for the first time in retirement as they begin drawing down accounts. The IRS watches this carefully because it is calculated on Form 8960, which must be attached to the return, and any error in the net investment income calculation will result in a notice. For a retiree with $120,000 in dividends and capital gains on top of $60,000 in Social Security and pension income, this is Senior USA Hub Channel. If this video told you something your financial advisor has not explained about your first retirement tax year, hit the like button right now and share this with any retiree who is in or approaching that transition. Tell me in the comments, were you surprised by any tax issue in your first year of retirement? I read every single one, and the most common situations become future videos. Subscribe for more valuable updates.